Ever wonder how the rich seem to get richer, even when they're borrowing money? It feels counterintuitive, right? Most of us are taught that debt is bad, a trap to be avoided at all costs. But what if I told you that for the wealthy, debt isn't a burden, it's a powerful tool? Today, we're going to pull back the curtain and reveal the secrets behind why rich people use debt to get ahead, while the rest of us are often stuck trying to save up cash. Let's start with a basic but crucial concept. There are two types of debt. There's bad debt, and there's good debt. Bad debt is probably what you're thinking of. It's the high-interest credit card balances for things that lose value, like fancy dinners, new clothes, or vacations. This kind of debt drains your wealth. You pay interest on something that doesn't make you any money back. It's a one-way street to financial struggle. But good debt, that's a completely different game. Good debt is borrowing money to buy assets that are expected to increase in value or generate income. Think about it. A loan for a rental property, a business expansion, or a portfolio of stocks. The key difference is that the asset you buy with the borrowed money is working for you. The goal is for the return from that asset to be higher than the interest you're repaying on the loan. This is how the rich use other people's money, specifically the bank's money, to build their own fortunes. Let's break this down with a simple example. Imagine you have $100,000 in cash. You could use that cash to buy a small rental property outright. Let's say it generates $8,000 in rental income per year. That's an 8% return on your cash. Not bad at all. Now, let's see how a wealthy person might approach this. Instead of using all their cash, they use that same $100,000 as a down payment for 5 different rental properties, each worth $100,000. They get loans from the bank for the remaining $400,000. Now, they control $500,000 worth of real estate. Even after paying the mortgage and expenses on all 5 properties, their net income might be, say, $20,000 a year. They've turned their original $100,000 into an investment that is generating a 20% annual return. They are earning more money and now own 5 appreciating assets instead of just 1. That's the power of leverage. This concept of leverage is absolutely fundamental. It's like using a lever to lift a heavy object you could unlift with your bare hands. In finance, debt is the lever. It allows you to control a large asset with a relatively small amount of your own money. By doing this, you amplify your potential returns. Of course, this also amplifies your risk, which is why it's crucial to invest in sound, well-researched assets. The wealthy don't just borrow money for anything. They borrow for strategic opportunities they're confident will pay off. Another huge reason the rich love debt is inflation. Inflation is the silent thief that erodes the value of your cash over time. If you have $100,000 sitting in a savings account earning less than 1% interest, but inflation is at 3%, you're actually losing purchasing power every single year. Your money is worth less tomorrow than it is today. But here's the genius part about debt and inflation. When you borrow money, you get to pay it back in the future with money that's worth less. Let's say you take out a $300,000 mortgage today. In 20 years, that $300,000 debt will still be $300,000 on paper, but the actual value of each dollar will have decreased due to inflation. So, you're paying back a large loan with cheaper money. Meanwhile, the asset you bought with that loan, like a house, has likely increased in value, keeping pace with or even beating inflation. In essence, inflation works in your favor when you're a borrower, but it works against you when you're a saver. The rich understand this dynamic perfectly. And then, there are the tax advantages. This is where things get really interesting. In many countries, the interest you pay on debt used for investments is tax-deductible. If you take out a loan to buy stocks or a rental property, the interest on that loan can often be deducted from your taxable income. This lowers your tax bill, effectively making the government subsidize your borrowing. Let's go back to our real estate example. The interest you pay on those mortgages for the rental properties. It's a business expense. You can deduct it from your rental income, which reduces the amount of tax you owe. So, not only are you using the bank's money to build wealth and letting inflation help you pay it back, but you're also getting a tax break for doing it. On the other hand, the interest you earn on your savings account, that's taxable income. The system is literally set up to reward borrowers and investors more than savers. This is why you often hear stories about billionaires paying very little in taxes relative to their wealth. It's not because they're hoarding cash. It's because their wealth is tied up in appreciating assets like company stock. When they need money to live on, they don't sell their stock, which would trigger a massive tax bill. Instead, they borrow against their assets. They take out a low-interest loan using their stock portfolio as collateral. Since it's a loan, it's not considered income, so it's not taxed. They get the cash they need, their assets continue to grow in value, and they avoid a huge tax event. It's a strategy known as buy, borrow, die. You buy assets. You borrow against them to live. And when you pass away, your heirs can inherit the assets at a stepped-up basis, which often wipes out the capital gains tax liability. So, let's recap the core principles. First, the rich understand the difference between good debt and bad debt. They only borrow for assets that will generate income or appreciate in value. Second, they use leverage to amplify their returns, controlling large assets with a small amount of their own capital. Third, they use debt as a hedge against inflation, paying back loans with money that's worth less over time. And fourth, they take full advantage of the tax deductions available for investment-related debt, legally lowering their tax burden. The mindset shift here is crucial. For most people, the goal is to be debt-free. For the wealthy, the goal is to have a high net worth, and smart debt is a key part of that equation. They see debt not as a sign of being broke, but as a financial instrument, a tool. It's about making your money, and other people's money, work as hard as possible for you. Now, this doesn't mean you should run out and take on a mountain of debt tomorrow. This strategy requires financial literacy, careful risk management, and a solid understanding of the assets you're investing in. The rich often have teams of financial advisors to help them navigate these complex decisions. But understanding the principles is the first step. It's about changing your perspective on cash and debt. Cash is not always king. In an inflationary world, cash that isn't invested is a depreciating asset. Smart debt, on the other hand, can be your ticket to building real, long-term wealth. Start small. Learn about different types of investments. Understand how interest rates work. Maybe your first good debt is a student loan for a degree that significantly increases your earning potential. Or maybe it's a small business loan for a venture you've thoroughly planned. The key is to move from a mindset of fear around debt to one of educated, strategic use. It's one of the most powerful financial lessons you can learn, and it's exactly how the rich stay ahead of the game. Thanks for watching today. If you found this breakdown helpful and it shifted your perspective even a little bit, do me a favor and hit that like button. And make sure you subscribe and turn on notifications so you don't miss our next video where we dive deeper into wealth building strategies. Let me know in the comments what's your view on debt now. See you in the next one.